Well, good evening, everyone. Welcome back to the channel. Thought I'd try to squeeze in another video here real quick about dividends so that I get a decent audience. And what I want to talk about today is so the market has been dropping quite a bit the last week or so. And what we're seeing is, the Fed is going to have to keep raising interest rates because inflation, unfortunately, is not slowing like we all hoped it would. That's a real bummer, but it's translating to the market dropping further because the last rate hike was less than many experts thought it would be. So the market ended up kind of rebounding in the month of January, but so far in February, we're starting to come back down. So I'm going to go over the ramifications for our favorite dividend ETFs of the market dropping. And let me just start the screen share here, and we'll look at Yahoo Finance. And so what I want to discuss here is so the Nasdaq has been dropping um, over the last week or so, and what we'll see when the Nasdaq drops, typically we see an inverse relation between the dividend payouts and the performance of the underlying index. So in the case of the Nasdaq, we peaked at around 1st or 2nd of February. We peaked around 12,200. We've lost over 400 points since then, and we're about 11,787 right now. So what we'll see for funds like the JEPQ, we'll probably see a return back to the higher payouts that we were seeing in November and December. So that can be a good thing in a way. That can be a silver lining to the market drops, because most of these are covered call ETFs, and the way covered calls work, again, like I keep reiterating in many of my videos, is when you sell a call and you collect a premium, in order to keep the whole premium, that option has to expire worthless, meaning that it never hits the strike price. So covered call premiums on the NASDAQ stocks, as the NASDAQ drops lower, it's more likely that you're never going to hit the strike price as the index drops lower. So typically when that happens, you're going to retain more of your premium. And then that, at least that's my theory, that leads to the higher payouts that we see. So if we look at historical prices here on the JEPQ, let's see, dividends only, going back a year. And it's hard to believe, like, inflation was really just starting to kick in for many of us about a year ago. So it's been a whole year now, because it was like February 2022, right before the whole Ukraine Russia thing started. So we can see the highest payout was in November. That's after the October drops in the market for the JEPQ. So we could see 68 cents November 1st, and then we got a solid almost 55 cents, then almost 58 cents twice in December. One was for November, one was for December. But we've seen the highest payouts in this fund when the NASDAQ drops. So like I say, that can kind of be a silver lining for that one. And then as far as the way the SVOL behaves, this one is supposed to be a volatility fund. And this one's really grown on me, like I've been talking about, because it's paying 16.43%. Not so much just the payout, because I never focus on the dividend payouts. Because what you can do, you can go to dividendetf.com or dividends.com, and you can filter, do a CSV spreadsheet, and then you'll find all the top paying dividends. But you've got to ask yourself why they're the top paying dividends. And 9 times out of 10, it's because of something that happened with the fund itself. And you could end up, if you don't do some critical thinking and research, you can end up getting yourself into a bad fund that was dropping. And I've actually done that myself before with some oil stocks. Some back in the day, like, there were these drilling companies that just were crude oil was struggling, so the companies were also struggling too, and they were paying out like 10% dividends, but it was because the stock was plummeting. So you got to watch for things like that. But with a fund like this, I like it not just for the dividend, but I like it for the low price. 22.42 is more affordable than JEPQ and many of the other ones that we like. And this one has been, over the last month or so, it's held fairly steady. But let's look at how the dividend behaves and the market fluctuation. Again, this is supposed to be a volatility play. So let's look at dividends only over the past year, and not options. Dividends only. Come on. See, this Yahoo's keeps jumping around on me. But anyway, on a side note, all of my fully edited faceless videos that I tried, those are over. So I'm not renewing with those people. They really disappointed me. And if they watch this, to be honest, you disappointed me. What I paid for to get very minimal views and stuff was quite disappointing. So, and I feel honestly, I feel like not to bash anybody, but I feel like I know as much about YouTube as they do, and I'm not an expert. But anyway, so the simplified volatility fund stays pretty much steady. It was a little higher in February and March and in December, but overall hangs around 32 cents. And I know this is probably a little redundant from what I discussed a couple of videos ago, but I just wanted to go over it in the context of this fluctuation because we were starting to, everybody was starting to say a bull market's coming. And now what you've seen in a couple of days, you're seeing the Dow and the Nasdaq move inversely, and the S&P, like one is up, one is down. So a lot of this has to do with um, interest rates. Like see here, Bank of America expects three more Fed rate hikes this year. And it just keeps going. Inflation's not coming to an end, unfortunately. And some people think it's going to persist a lot longer, which is a real bummer. Now let's look at another one of my favorite sites that I haven't looked at in a while, Forex Factory. This tells you all the news coming up here. So you can get a better idea if you're trading, you can get a better idea of what's coming. So for today, we had a FOMC member speak. That didn't seem to move the markets much. And then we had another minor event. The events are labeled based on impact. Like if they're in red, then it's very impactful. So let's do this. 18th, obviously there's no news on weekends for US based. So the 20th, and that's a bank holiday, markets are closed. And for Tuesday, we've got, well, you see Canada and the UK have some news, but US, we have PMI, flash sales, and it looks like the one thing. But this is how you keep an eye on, like when the Fed chairman's going to speak, when Fed members are going to speak, when there's going to be a rate hike or a rate announcement. See, like next Wednesday, we have FOMC meeting minutes. And then Thursday, we have preliminary GDP. So that could be a big market mover. These are all things people trade on. And then we have core PCE Friday, and that's what we're looking at for the next week. But just thought I would go over that because it's important in the context of this current market that we're dealing with. It's important to think about on these favorite ETFs of ours what the payouts potentially are going to be. So just wanted to get a quick one out for you all this evening. Hope you liked that. If you did, please remember to like, comment, and subscribe. If you didn't, also subscribe because there's something here for everybody. Thanks so much for watching. Take care. Have a good weekend.